Welcome back, ladies and gentlemen, to another episode of Almost Wealthy. I'm going to talk about SCHG today. And before we get started, I want to thank everyone for comment, like, subscribing. I really appreciate it. And I'm hoping everyone likes the content. So let's get into it. Pretty much every week I check SCHG, which is the ETF I use to build collateral, which is up around 4.18% this year. The S&P 500 is up 8.03% this year, nearly 4 points behind. So when I analyze these things, I'm always thinking, should I be worried? I'm going to give you 3 reasons why I think that way. When looking at SCHG, I notice 3 things stacking against it. First, the rest of the market kind of woke up, and that's what's been happening this last pretty much 4 weeks when we've hit all-time high on everything. For most of 2024 and into 2025, a small group of tech giants drove the entire market for the S&P 500. And then in late 2025, everything else started joining in. Like you had your financials, your energies, your industrials. Pretty much all the market was moving all together. When that happens, the S&P rises across the board. But SCHG is almost 48% technology. So when everything else catches up, SCHG looks flat. But it doesn't run with the rest of the market like the S&P 500 does, due to the fact that it's tech heavy. Number 2 is DeepSeek. DeepSeek hit in January 2026. It's an AI company that appeared out of pretty much nowhere, claiming they built AI as powerful as the top US models for a fraction of the cost. When that happened, NVIDIA fell 17% in a single day, which was the worst single day market cap loss for any company in the US history. And NVIDIA is about 12% of SCHG. So when you think about it, every company that was riding on that AI wave sold off. And SCHG is full of those type of companies. Third is the tariff pressure. If you look at the holdings right here, as I scroll down, you have Apple at 9.7%, Microsoft at 6.89%, NVIDIA at 12%. Those 3 companies alone are almost 30% of the entire fund. All 3 have massive global chains. The tariff fear hits those companies directly. Those 3 things that happen pretty much all in the same window. That's why I believe SCHG is trailing this year. Now here's a snapshot of SCHG. Net assets, 59.19 billion. Number of holdings, 196. Your expense ratio is 0.4%. That's $4 in fees for every $10,000 invested per year, which is basically free. Average company size is 1.8 trillion. So when you think about it in that form, they aren't betting on unproven companies and unproven startups. These are the most dominant businesses that have ever existed. As I go to the holdings, if I scroll down, you can see that NVIDIA, Apple, Microsoft, Amazon, Alphabet, you have Broadcom, Tesla, Eli Lilly, Visa, Costco, MasterCard, United Health Group, just to name a few. But if you look at the top 5 companies, they are nearly 40% of the entire fund. That concentration is what makes SCHG so volatile in rough stretches. On the other side, it's also what makes it outperform when those companies run. Both of these scenarios are true. All right, so let's analyze the performance table for SCHG in the S&P 500. So if you look at the 5-year year-to-date, you see that SCHG is up 15.89%. And if I go to SPYs, the 5-year is at 13.79%. So SCHG is already ahead. I go back and I look at the 10-year, which is 18.84%. And then I go to SPY, which is 15.48%. SCHG is pretty much beating the S&P by 3% per year, every year for a decade. That might sound small, but here's what it actually means. If you take $10,000 invested 10 years ago, SCHG 18.86%, that's roughly $56,300 today. And S&P, the 15.5%, that's the same 10,000 is roughly 42,300. That's almost $14,000 more from the same original investment. And that gap gets bigger the longer you hold. Now think about what this means for my buy, borrow, die strategy specifically. My collateral is what I borrow against. More collateral equals more borrowing power. More borrowing power equals more bills I can move over from my paycheck and into the loan. More of my paycheck will be going into the portfolio equals everything grows much faster. Beating the S&P by almost 3% per year doesn't just grow my balance. It accelerates the whole machine. Most investors measure year to year when their ETFs lag. So when their ETFs lags, they get antsy and start looking for whatever ran last. That instinct is how people end up buying high and selling low, basically repeating bad habits. The way I'm looking at it from a buy, borrow, die strategy is different. My time horizon is in decades, it's not in years. I don't need SCHG to win every quarter. I need it to be bigger in 10 to 20 to 30 years from today. And panic selling collateral doesn't just hurt returns, it breaks my whole strategy. That's a margin call I don't want to happen. And if you look at history, growth stocks don't lag forever. So right now, my portfolio is sitting at 8,800 in portfolio value. I'm in phase 1 of my bill stacking plan. My bill right now is at $98 a month. And if I go to my borrowing, I'm borrowing $340.50 right now. My phase 2 starts at $10,000. So just to wrap it up, a 10-year annualized return is 18.86% on SCHG. From that standpoint, I know which number I'm building on. I do this for all my ETFs. I pull up any ETF I own. I look at the long-term return numbers versus the benchmarks. I check the expense ratios, check the top holdings. I always like to check the news and see if anything's changing with the funds. That's a habit for me to keep grounded in what my ETF funds are actually doing, and so I don't react to most of the noise. So if you like this content, hit subscribe. If you want to follow along every week with real numbers from my exact portfolio, drop a comment, like, and I'll see you on the next one.